Brent crude oil is trading down about 1% in Asian trade this morning. It would appear that the somewhat optimistic reporting at the end of last week about a imminent China reopening on the back of abandoning its zero COVID policy has been sort of tapered over the weekend with more sort of conservative commentary from China saying that they were still completely committed to their zero COVID policy. And so we're seeing that pull back a little bit this morning. Let's kick off, as always, Monday morning with Omar Najia, Global Head of Derivatives at BB Energy. Omar, good morning. This is the Monday morning in which COP27 starts. It looks like the oil markets aren't really concerned about the outcome of COP27. Your thoughts this Monday morning?
Yeah, I mean, it's a question of credibility, right? So it's supposed to be carbon zero, no cars, renewables, blah, blah, blah. And they're burning coal. So, they can talk. I mean, it's interesting. They can all kind of, get together and all that kind of stuff. But I don't think it's going to make a blind bit of difference, basically. But I think in terms of the oil market, we'd still expect it to tick a little bit higher. TI is like 91, something like that. And I think that gets, maybe like $9-10 a barrel higher. Hopefully before the end of the year, and then comes off from there, basically. So we're looking for a corrective move up, but definitely for a bigger kind of move up. Whether that has to do with COVID, no COVID, wars, Biden elections, whatever, I'm sure that'll be tagged onto it, but higher, basically. Equities lower, parity US dollar GBP lower in terms of the euro. What else? That's about it.
That's all.
Yeah.
and all before Santa Claus
Christmas.
Parody on the sterling, why not? Walter Simpson, good morning and welcome. Nice to have you back with us, Managing Director of CCED in Oman. The big question we had yesterday of our podcast coming out of our regular guest, Mike Muller, was what will OPEC Plus do next month, given they've made this commitment to an outlook of cutting 2 million barrels from quotas, presumably whatever number of that would be actual barrels, but going into a December meeting, which is now only weeks away again, should we expect less barrels on the market from OPEC Plus in December than we've had in November? Your outlook, please.
Well, thank you for that. I think it's a difficult one to predict, but what I would say is what I've always said: where they've been successful, they tend to stuck with their policy. So I think there will be a very strong debate, about further cuts to maintain the oil prices, and I think that it'll be a tougher one this time around, because I think they're actually starting to hit production if they make another cut rather than just cutting excess. So it's going to be a tough discussion, but I certainly think it will be had. And I think there may well be further cuts to come to keep that price up.
Beyond the 2 million quota, or more people participating in real cuts?
More people participating is what I think they're going to push for. But whether it'll happen, that's a tough one. We're starting to get where you're actually going to affect the revenue streams rather than a symbolic cut for production that wasn't there. You're going to start to hit revenue streams, and I think that's going to be a really tough discussion for people.
Let's go to Singapore with Valerie Chow, Vice President, Head of APAC Gas and LNG Research at Wood Mackenzie. Valerie, what did you think over the weekend when you heard the news that China was reopening and then maybe not so much? I mean, on the LNG markets, that's a big deal.
Yeah, thanks, Sean. I think, to be honest, I kind of expected that. I mean, the rumors that came out, kind of midweek last week were just basically that. They were kind of rumors, right? And I think the market's been so beaten down between equities, for example, that, people are just looking for an excuse to almost buy, it feels like. So I wasn't surprised, that the Chinese then came out and kind of basically pull apart everything, right? There was a kind of rumor in the market. I mean, obviously, you've seen an immediate reaction to that to some extent, right, across the board. But I think as far as gas is concerned, I don't think we've really seen a massive reaction from the gas side. If anything, what's happened over the last month, it's all entirely been driven by the weather in Europe and kind of weather and storage, and maybe we can get into that a bit later. But that drop off has really, I think it does help, but we're still not seeing a real demand response coming in from, let's say, Northeast Asia in terms of buying up more, because Asian kind of countries like China, Japan, Korea, pretty fairly well stocked at this point going into winter.
Omar, we've talked in the past about where the US dollar goes and where it may peak in this variety of outlooks you shared in your earlier comment. You didn't bring us the dollar, except you did parity on the sterling. But where do you see the dollar across the board in terms of it peaking versus interest rates movements?
Oh, well, interest rates, I think, are going way north. I mean, way north. I wouldn't be surprised to see double-digit interest rates, to be really honest. So I think this talk about 5%, 6%, 7% is all just pie in the sky. So I think considerably high. But dollar, I think. So DXY is the dollar index. It has about 60% of the euro, about 13% of the GDP. So I think what's going to happen is that the dollar index is going to tick higher, has new highs to come, probably above 120. 120%. So that'll basically take the GBP down to parity, because I think it's the UK economy is not doing well, and the euro basically gets to maybe like 90, 85, something like that. But only then does the dollar index start to fall after it peaks at 120, something like that, and then you see a reversal. So dollar index down, GBP up. Euro up, but in terms of all of them, I'd hold the dollar more than anything else, because I think nobody knows what's going to happen to Europe after the winter, especially politically. You're seeing a big rise in the right in Europe, and some of it is going to be pretty scary. You've seen panic in the UK. With a change of 3 prime ministers, and I don't know how long. I think Biden is going to get absolutely trounced on this election. So I would worry. I think basically, so the idea being that you see a big drop in the stock market, you see the dollar index start to rise because it's a safe haven. You see pandemonium in terms of geopolitics, a safe haven. And once you come out of the kind of winter and the snow starts to melt and everybody says, the West is winning, yay, then you start to see basically the dollar index and the dollar come off, and the others kind of, the little mini-me's, euro and GDP start to kind of stabilize. And it's very interesting because there's been a lot of reports about Russia and China and the BRICS and the Shanghai Cooperation Organization all looking to make basically a counterweight to the dollar, another kind of reserve currency based on a basket, including commodities and gold and other commodities. So the days of the dollar being the kind of reserve currency all around the world, the number doesn't mean it's going to change tomorrow, but it means that the trend is in place and nothing is going to change it. Same with the West, same with the order, rules-based order. All that is gone. It's just a question. It's like it's like death. It doesn't. It's a process of decay, and an arm falls off here, a leg falls off there, and then the head drops off. But it's all coming.
It's kind of like Monty Python, right? They chop the arm off, they chop the legs off. I'm still going. I'm still a contender. Walter, meanwhile, back in reality land of actually digging oil out of the ground, I'm trying to understand where sort of the capacity issue is at. We're seeing in the US, again, another big story in the Wall Street Journal yesterday, that frackers are saying oil production is slowing in the US shale patch, basically due to the lack of available of manpower and materials, supply chain, etc. Rather than the incentive, the monetary incentive might be there, but the supply chain to support expansion is not. How is that square the circle where OPEC's announcing what is on the paper at least, a massive cut in supply, a massive cut, you would think, in demand on supply chain. How do these two things go together, do you think?
Well, I'm not sure they do, in a sense. The supply chain issues are being driven by, you know, the fallback from, or the fallout from COVID and the challenges that brought, and then also with, you know, the threats of recession and everything that goes with that is making the supply chain really challenged at present, and we're seeing that worldwide. So all of your deliveries of equipment are delayed. Getting people back to work is a challenge, and we've seen that particularly in Western countries where this work from home desire has come in. So I think all of that is a real challenge to it, and I think it's going to compound the supply side, because it's going to be more difficult.
I struggle to see how that, I mean, the oil companies, and we're seeing it in the headlines now in the last weeks or two because of the quarterly earning results, are making absolute, I mean, fortune is a small word for what those numbers are. And yet, so you would think the companies, certainly on the major level, have the financial muscle to solve any problem that might exist, right? You know, no, I won't work for $10 an hour, I'll work for 20. Okay, here's 20. I mean, it doesn't seem like the monetary challenge is a valid one in terms of for the oil companies to solve some of these problems. I don't quite get that picture. How do those two things go together?
So I think it depends which economy you're talking about, if I'm honest. If you're in this part of the world, or if you're in South Asia, yes, you can get people if you can move them based with borders and visas, etc. That's not so true in Europe and the US, where this industry is not as popular with the workforce. You know, we go through a number of cycles, and we've always done that, and we lay people off and we get them back. What we're finding this time around is people don't want to come back. Now, that's partly with the reputation the industry has, but I think it's partly with COVID and hey, I've had enough now, that's it, don't want to come back. So I think there is a challenge around getting people back, which isn't money related, but also recognize that, you know, the investors in these big oil companies, they're wanting some cash out for a change. You know, they've gone years of hardship. Suddenly these big profits, they're wanting their share of that in return in dividends. And so not all of the money that is being made is being ploughed back into investment. And I think that's going to be a challenge for supply going forward, because if you believe the ADIPEC numbers, $1 trillion a year of investment required to keep up with the hydrocarbon demand. I don't know where that money's coming from myself. That's a huge investment every year. It's going to be a real challenge for the industry to meet.
Well, it isn't. It hasn't happened for many, many years. The peak, I think, 2014 at 750 billion, and it has been a decline ever since. Val, I wanted to get your sense of where Asia's at. Clearly, everybody's looking to China. Will they, won't they? You know, it's kind of like sitting on the edge of your seat stuff. Market pops, then it doesn't. Where's the rest of Asia under these circumstances? We quite often get this sort of label of headline energy crisis in Europe. What's happening in Asia? I mean, if there's an energy crisis in Europe, there's an energy crisis in Asia, as far as I'm concerned, because ultimately they're all competing for the same barrel, the same tanker of gas. And so going into winter.
Yeah, indeed. So I think it's kind of nuanced across the different regions. So I think in Northeast Asia, there's really probably not so much panic there. I think, again, like I said, the Japanese, the Koreans, Taiwan seem pretty okay, you know, going in terms of storage. I think that's obviously been helped by the kind of warmer weather that we've seen over the last 2 months in the Northern Hemisphere. China seems kind of okay, I guess, with their gas balances at this point in time. But I think where you're finding the real hurt is places like South Asia. So in particular, I'm thinking about Bangladesh and Pakistan, where over the last few months, you've seen rolling blackouts, load shedding. In fact, there was just about start of, I think, last month, or this month rather, there was early October, there was a massive kind of blackout in Bangladesh, impacting over 130 million people. 80% of the country was without electricity for hours on end. And that kind of really reflects the shortage of LNG, they countries like Bangladesh, Pakistan, they can't afford to pay the LNG prices that we've seen of late, which of course no doubt has been due to the Ukrainian war and all that. So even at current kind of $30 per MMBTU numbers, right? These are at kind of spot prices. These are incredible numbers for developing countries to pay. So what has happened, I think, in exchange is that you're starting to see a bit more diesel use. You're starting to see countries use as much fuel as they can. And then you can't mention the point around COP27, right? So I think the bad news from Asia is that carbon emissions have just gone up, right? This through the pure use of coal and more oil. But I think at this point in time, the real thinking is energy security and energy affordability. The point around the transition is kind of still there, but I think most governments would probably have put that on the wayside and kind of say, hey, we can figure those things out and deal with that later. But right here, right now, that's kind of way more important.
Oh, and on that point, if China obviously comes to the end of the year, everything is going to be lower in China this year, GDP growth, energy demand. But in the expectation and the outlook that, of course, 2023, China starts to reopen in some way or other, I think most people would expect that. Where does that leave their LNG demand posture? Because clearly they were, I think, before the COVID lockdown, the world had become the world's largest LNG importer.
Indeed. So I think we've obviously seen a very big drop between last year and this year. So I think last year they kind of landed around 83 million tons. This year we think that they get to about 68, which is a massive drop off. And we've never seen anything like this in China, right? So that's like talking about 14 million tons drop off. I don't think we've seen anything like this anywhere in the world. But we think that with the opening next year, right, we could kind of expect anywhere from flat demand growth in terms of LNG to a slightly positive number. So maybe a 4 or 5 million tons extra, which is positive growth, I think. And I think from a Chinese standpoint, that'd be good. I mean, from a world standpoint, that'd be good, right? To see China growing again and factories running again. So it's open question, I guess, to be honest, when they open up, if they open up. As of the weekend, I think they still seem to be dead set on dynamic COVID strategy. But if we can't go into a global recession next year, I imagine that even at some point the Chinese officials will want to get some economic activity going, right? And so we just have to watch the space and see how the whole COVID thing pans out.
Omar, when we look at the outlook for the oil markets, as you articulated in your earlier points, you didn't put on your list as well. I sort of said you didn't put the dollar on the list. Now I'm telling you another thing you didn't put on your list, the infamous oil price cap that the G7 is trying to cook up in their kitchen. My head's a little bit dizzy about whether it means, if it means anything. Your thoughts on it? Are you paying? Are traders paying attention to it? Is it going to impact your business? What do you think this looks like? You're on mute, sorry.
So it's a complete joke. It's the same with all the sanctions, quote unquote, imposed by Europe and the US and all this kind. It's a complete joke. So,
but it will have some legal parameters to it that people will.
Who cares? Who cares? Honestly, who cares? Who cares about the legal, whatever? They can, sit and do the legal and say, no, if you want to scratch this here, you can't do this, you have to do this. But, honestly, who cares? So at the end of the day, oil is either going to get, it's very simple, right? So the West says we're going to cap Russian oil, right? We're going to set a price of whatever it is, a fixed price, mind you. So $50, $60, whatever. Russia says anybody who joins the price capping, we're not going to sell you oil. Finished. End of discussion. Very simple. So if you want oil, then basically what you do is Europe and the US is you go, so I can't buy the oil from Val directly. So I now have to buy the oil from Sean, who buys it from Val, but I'll just close my eyes and pretend, it's not. So what happens? I pay a premium for this oil, and then Val goes and sells to the East, China, and whatever it is at a discount. So who suffers? Not Russia, not China, not the Far East, but Europe, because we are standing with Ukraine, freedom, democracy. Here we go. So what's going to be interesting is when this stuff, and it's a rolling thing. It's not like it's going to end. It's going to become even worse next winter. What I want to see is the Europeans and the US, citizens, how much they're going to keep, putting hand in pocket to pay for, I want to be with Ukraine. I love Ukraine. Give them more money. Give them more this. Give them more this. Because I'm betting that at some point, they're going to discover that they don't really care. Because, the West is such a great, we say all this stuff, democracy, justice and all this kind of stuff. We kill people, we bomb people, we imprison people. So again, the oil market, it's all very nice to say, we're going to sanction, but in reality is nothing's going to change. The price is going to go up for Europe. That's it.
Walter, I mean, to take that sort of broader theme, obviously, as we started out our conversation, two big events this week, US elections tomorrow, and obviously the start of COP27 today. The oil markets seem that they're not considering either to be an event of concern, at least from the market's point of view. From an industry point of view, what would you be watching for the outcome of both to be of relevance?
So for COP, it's really what the fallout is in terms of further investment in the environmental agenda and the ESG strategies that every company has. A deadline's going to be moved, are going to be brought forward, are they going to be tougher? What's going to happen on that? And we're already seeing, from COP26, it's taken time, but we're now starting to see those deadlines being requested, plans, how you're going to meet them, what investments you're going to put in to meet those. And so it takes time for the decisions and the discussion to move the industry, but they do eventually. So, what's going to come out of this COP that we're going to have to allow for in our planning going forward. In terms of the US elections, I don't think the outcome is going to be a surprise to anybody, to be honest. So we'll see what that happens to that. Not so sure that's going to have a direct impact on us here, to be honest with you. I think relations are bad enough as it is, and they can probably only improve.
Right. Let's go to the survey question, which is sort of addressing the point made in the chat this morning. The oil markets appear unconcerned about the outcome of COP27. Agree or disagree? Val, when we look out, as Omar indicated there, and increasingly you're hearing now the conversation move from the energy crisis point of view to the winter out, not the winter we're about to enter. What are we seeing in the markets and in the sort of dynamics of LNG in particular, but across the energy complex that starts to signal the direction of travel for the winter out? Yeah.
So I think you've got two competing dynamics. The first one is obviously on the macro front. So if you kind of take Omar's view that, it's going to be, your oil house is going to break loose next year economic-wise, then that's obviously going to be a very, very bad thing for demand. And, under such circumstances, you expect that all commodities will kind of end up, more tilted towards the downside, right? So, I would say that, coal will probably go down first, and then oil, and then followed by gas. Gas is a bit more sticky given, you can't just find substitutes just yet. But I think that plays against the secondary dynamic, which is, it's all going to be kind of weather driven. If we assume, as we do in WoodMac, that the Russian pipeline gas is basically a non-starter for Europe, right? And that's, with the exception of maybe the Turkish stream flows into Europe, everything else is going to be cut, right? So what that leaves is Europe effectively 100% dependent, either on kind of its traditional source of gas from Norway or Algeria, and some coming in from Central Asia. But that's not going to fill, right, the gap left by Russian pipeline gas, which also means that Europe is basically hostage to the dynamics of the global industry. Now, there's a question around price caps, right, which is kind of similar to the oil side of things. I would say that I think they're going to struggle to impose gas price caps, especially on the LNG market, because I think we've already seen the Qataris come out to basically say, hey, look, you kind of put these caps in, we're going to sell it to the highest bidder, right? And I don't care what agreement we sign, we will honor our contracts, right? But for everything else, we're going to spend it where we're going to sell it to, even if someone pays us 1 cent more, right? And that can't make sense. Free market, that's what you would expect.
Where would the question I have is, ultimately, where is China's appetite for these level of LNG prices, given that obviously the LNG market, that China has been relatively absent this year, at least on the marginal growth, if you like, and certainly they've declined. But going into 2023, if we see this sort of Europe in a more desperate state, meaning it'll be more desperate to acquire in the LNG market, less pipeline, how will China compete with that? Will China be ready to trump pay more than Europe?
Well, I think China has kind of coal to fall back on, right? So I think at least as far as power generation and heating is concerned, they will use as much of coal as they can, right? It's not because they like using coal, right? I mean, clearly there are air pollution issues and carbon consequences from that. But when it comes down to affordability of energy, right? You can't go with the lowest cost option. So if the Europeans are happy to pay for that, right? I think the Chinese buyers will just step out of the spot market as they've done over the whole course of this year. China is still kind of buying, LNG en masse from its long-term contracted position, so there's no issues there. To the extent they can, most likely they'll kind of max out their take-or-pay levels, right, just to kind of get LNG at a cheaper rate compared to spot markets. So I think, but I suspect very much that they will maintain a stance that they have this year, right? To just step out of the spot market, let the Europeans do what they want to do. I mean, China also has a slight advantage, meaning that they can buy gas from the likes of Russia, right? LNG from Russia. So discounted volumes from the likes of Sakhalin, right? Great. I'll take it, right? If the Europeans don't want it.
That'll be the default option for China going forward. Omar, just to close out, I wanted to get your thoughts as to where, as we go into 2023, and as you articulated, interest rates likely to go a lot higher, inflation remaining quite high. Where does oil and commodities sustain as a hedge in that environment and attract in the investment funds, and your thoughts on that dynamic from a market point of view with a lot of sort of net interest? Sorry, you're on mute again.
So if you look at oil long term in terms of an industry, it's impossible to get financing because nobody wants to be told that you can buy something now, but in 10 years, it's going to go to zero. So nobody's interested. Nobody will be interested. So forget about investment coming in. That's one. In terms of oil as a...
Yeah, but they're offering massive dividends. I mean, shareholders and equity investors will be quite attracted by that.
Well, think about it like this, right? So when you buy something, let's say I say to you, look, this rock usually retails for $100, but you can buy it for $1. But you got to sell it at the end of the year, right? Now, you might think that, wow, it's really attractive and I might as well go into it, blah, blah, blah. But then everybody knows that you have to sell it by the end of the year. So it's not a good investment. The fact that basically somebody's offering you like a little carrot now, here, come and take it. You might as well invest, look at what's going to happen, blah, blah, blah. And you've got a massive time thing in front of you, 10 years, whatever it is. It's not a good investment. It really isn't. Especially, I mean, anything that you want to invest in, like if you want to invest in shale just uses so much money, needs so much cash flow, that shale at 5, 6, 7, 8, 9% interest, you can forget it. You can absolutely forget it. Shale only works if interest rates are zero or negative. I mean, it's like you invest $1 billion, you make 100 billion, you say yay, and then look what happened to the industry. It's a joke. Everybody's been saying, shale will come back, shale will come back. It's never going to come back. So I don't think that you're going to see investment. Oil is very interesting because either once we get to about $100, oil will have to make a very big kind of decision. Either we go, in my mind, either we go 180 and then we're off to the races and we absolutely blow to the upside, or we go 100 and then all the way back down to 60 painfully maybe for the whole of 2023, and only then start on the upside. But commodities are, cyclical. Everything needs or is looking to kind of correct a little bit, but the trend is upwards. The idea is the same with oil and investments. You want to trade the trend. You don't want to worry about the little, markets coming off a little bit, markets going up a little bit. And there's the same with investment in oil. You want to trade the trend. You don't want to trade it for like a couple of days and see what happens and all this kind of stuff. Especially if you're investing, you want the long view. The long view for commodities in general are considerably higher prices. Whether that starts in 23, in 24, we don't know. And it's very simple. Why? Why? Is it an act of God? No. It's the fact that basically the West has been using dollars, euro, paper to solve every single problem they've ever had, right? They've become completely financialized. They make very little. They grow very little. They have very few resources. Now, that's more Europe than the US. And they solve everything by just printing money. Brrr. That's it. The world is changing.
Let's get the survey result. Give Walter the last word. The oil markets appear unconcerned, 9-1 in this room, at least. Walter, I mean, the narrative that Omar is reflecting there is not too disconnected from what you were saying earlier. Ultimately, if the industry requires $1 trillion of investment a year in order to meet future oil and gas demand, and it's only getting half of that, or even much less than half of that, 1 and 1 is 2, shortage, prices higher. Outlook for 23 from a price point looks rather bullish.
Look, I don't say I agree with everything I was saying, but in principle, I don't think there's going to be enough investment in oil for us to keep up with the demand. I think it's that simple. So yes, I think prices are going to go up. Now, whether that happens next year or the year after or the year after that, that's a really good challenge that you need a crystal ball for. But in principle, absolutely.
Staying where they are is quite staying where they are at a minimum is quite elevated. They don't need to go much higher for it to be productive for the industry.
I'd be quite happy if they hover around here for another year. And look, as we've talked before, the volatility is still there. There's a deja vu to the conversation we've been having for the last year about all of the challenges that go with it. And I think they're going to continue, and I think we'll have those ups and downs, and they may be quite significant ups and downs. But on average, I think we're going to see a price that's slowly going up.
And the volatility, while it might be dramatic on a day like it was on Friday, it's still in a band, it seems, the 90s, and has been for quite some time, besides brief moments drop down in the 80s. But ultimately, the 90s seem to be a sticky place, up and down $2 or $3, $4 in a day, but nonetheless still in that box. Thank you very much. We have to wrap it up there. Val Chow in Singapore, thank you very much. Just seeing it posted on the link there, our Oman Energy Forum coming in 2 weeks' time. So if you're in Muscat or not, please come and join us. Our first physical return to in-person forum in Oman after 3 years. So will really be great to be with Walter and all of his peer group in Muscat. Omar Najid, always, thank you so much for your insights this Monday morning. Have a great day. And Walter Simpson, thank you also. Have a great day. Catch up with everybody 10:30 each morning. All the best.
Thanks very much.